Hey, welcome back. It's Joshua Bellinger of CounterVest, and I do have a trade I'm going to share with you, but what we're going to cover beforehand is the pitfalls of following unusual option activity. I'm going to explain exactly why. So let's take a look here at Zynga. This is our example today. So this is a stock that people would say, or not people, I'm sorry. This is a stock that came out of my system as what would can be considered hot money because of aggressive buying out of the money and the short-term nature of this. So what I'm looking at is about a 350% increase in volume traded with the options on this one. And that's the options overall, mostly focused on the call. So let's take a look here at exactly, well, before we do that, let's take a look here at the stock. Kind of getting ahead of myself. So the reason why we're talking about Zynga was because of call activity, but what we're looking at here is that earnings have happened. So again, we are past earnings. I know we jump around from stock to stock or different opportunities of what to trade, but it's a marketplace, and what we're doing and what I'm working on with you is how to evaluate opportunities. Sometimes you find them, and sometimes you stumble across them. And finding them, you have a system, and stumbling across them is you just look. I mean, there's people on the weekends that look through all the charts to look for patterns. That's just crazy. You can have systems to help you alert, but it's a marketplace, and you're looking for opportunities that fit fit your parameters. You're shopping, you're sitting there, you let them come to you like that, and then hit the bid. So anyways, on this one, we have the earnings that's already happened, sold off pretty aggressively here, held $8 and starting to firm up. So the activity not only today, but I'm going to take you back to activity last week that was more interesting. But what we're seeing here is that we pulled back here, and previously in another video I talked about fading the dip. This one looks like you could have and still the opportunity to fade the dip. Some people would talk about this move here, about filling that gap. I don't know if that's going to fill. I mean, that's going to take some time. It's a $7 stock. I mean, it is what it is. But not saying there's not an opportunity here. So anyways, we're looking at here today on this one. And keep in mind, it's a $7 stock. Because when you look at these options, a lot of people will go to these options and say, oh, there's great opportunity here. And I mean, it's not. It's a $7 stock, $8 stock. And it's almost like an option at that point. I often say it's better to trade the stock than it is to trade the options. There's liquidity issues with options. Options are messy. If you're going to trade the stock, it's better just to trade the stock. So anyways, what we're seeing here is we have activity here in the the contract that expires next Friday. Tomorrow's monthly expiration, what we see here, one day. So we had some activity flowing into the 8.5s, and we had activity flowing into the 9s. Now, if we look at the overall activity, well, we see some activity in September as well, but not 227 on the call side and 31,000 on the put side. So that's what we're looking at today. And what stood out overall is when you start to look at this activity here, and specifically the reason why I wanted to talk about September. So some people would look at this and say, going on in September here, what's this, this activity here? Well, this activity is actually, without knowing, and this is why it's a hidden trap, because people just follow. There's a thing going around, is follow the flow, follow the money. I say follow the money to a point. I mean, to a point of like knowing what to follow and why to follow it and how to then structure trades. What we're seeing here is that this 8-9 spread, this was a spread that was put on previously. This was actually closed and rolled into October, which we see here. And this is why it's important to know the chain, having a chain of command of a position this size. This is an institutional trade that was put on here, and they're rolling it into October. Now that is interesting. It's interesting because it is now 57 days, and what we just saw here firmed up on the 8th. And when you look at that as well, I mean, a firm could be short, and they're using that as a hedge, possible hedge. Not saying that is exactly the case, but there's different things that go into it. And even if it is a hedge, they are still worried about a possible move higher against them. So not necessarily a bad thing that there is a hedge, but just to understand the market structure or the trade structure of what they're possibly having on. The ambiguity is the tough part. When someone says buying calls out of the money, you know what they're playing. They're playing for a big move out of the money. So when you start to look at this order flow or start to look at these orders, you have to start piecing things together. And that's why sometimes it can get a little complicated. But overall here, what's interesting when we go back is, okay, Josh, so they rolled that position and they rolled it into the October, and they're buying the 9/12 spread here. So that sounds interesting, Josh. It's a 9/12 spread. What is it? Let's just say 9/12, 15. So 35 cents. 35 cents for a pop higher. Does it go to $12? I don't think so. I mean, $12 is all the way back up to here. I mean, is it just going to shoot up higher? I mean, that's why it's kind of silly. They're selling junk against it, but that's the reason why I would say it almost could be a hedge on a short position, because they're trying to buy something to protect them, and they're selling junk all the way out there. But again, what do I know? They could. This is a takeover possibility. Possible. I'm not saying it is. Just looking at a $7 or $8 stock and just putting things together. I mean, it could be in play for a takeover. That's always the wild card. But anyways, you do have that kind of bullish positioning. But the other thing that stood out was actually last week on the 13th, and this was the position here. So we'll wrap this up and go into what we could do. The 9/11 spread was bought here in December. That's 126 days. And then also on the other side here, they were selling the puts. This is not showing up here. It's on the 13th. Oh, they were selling the October puts here. So they're buying longer term, and that's what you want to do. If you're buying, you want to buy time. Try to get as much time. And if you're selling, you want to sell as short as possible for that decay to kick in. And that would be right where that 63 days is. So they were selling those sevens and then buying that spread and using some of those proceeds to offset that spread. So that's interesting. We talk about these big footprints. That's a footprint that's very interesting. Now, what's the trade that we could look at? Well, honestly, you could do a spread with volatility at these levels here. I mean, it's a volatile stock as is. I mean, I wouldn't necessarily say a spread, and the reason why is because it's such a cheap stock. I mean, it's just, it would be silly, and it depends on your account. I mean, if you have a small account, then yes, you have to do a spread. You have to buy something cheap here. So I mean, if you looked at 29 days and you sold an 8, and you try to get filled something down here, I mean, at the 6. Got 2 points of risk, but you're not really getting much, and you're going to have to, that's the tough thing about these cheap stocks, is that you want to get some meat. I know people talk about like buying an option at 23 cents and selling it at 30 cents. Wow, it sounds great percentage-wise, but commissions and so forth. I mean, it's just, you have to have big size, and you're just really, I mean, that's a tough trade. And that's why options are difficult. Day trading them. So. If we looked on 43-day cycle, let's say what could we get there? I mean, at the 8 strike here, we get a little bit we get something there, right? We get something where, you get 45 cents, you could probably manage it at 20 cents, on there. And, you possibly, if you're, very bullish, you can look into that December cycle as well and to buy a spread on there. But for trade-wise, hey, I'm looking at just a put, short a put on this one. Not necessarily what I'm going to do. This is what I would be looking to do. I think there's just better opportunities for different capital accounts, for a smaller one, or for an account here. If you're bullish on this one, this is an interesting one. Or you can buy the stock and sell a call. I mean, there's all kinds of different ways, but that's how you start to dissect something and get to a overall outcome of what you possibly want to do, what trade. So that's what I have for you, and that's the good thing about order flow of option activity, because someone's positioning. And what we just talked about, the bad thing is knowing what was on beforehand, if they're being bought to open, or if it is what looks to be a bullish position. Is it really bullish, or is it just the fact that someone's trying to do a position to hedge what they already have? Someone that's short already, institution-wise, because this is under $10, they're just trying to protect what they have here. Some institution may have one on the other side to build a position and start to do that as well. So typically on that kind of size, those are going to be released every quarter by an institution that does take that. So their position now, we see it, and then later on we figure out, oh, it was them that put that on. So that's what I have for you. Zynga, hey, it's an $8 stock. You find a trade. And this is not a long-term investment, but there's opportunities, and this is one of them. We'll see you in the next video, and until then, take care.